Gas got cheaper, and the market threw a party. Cheaper gas, the story goes, means inflation's beaten. Beaten inflation means the Fed cuts, and a cutting Fed means it's safe to pile back in. Here's the part that didn't make the headline. While gas prices were falling, the New York Fed's own survey of what people expect inflation to do jumped to 3.7%, the highest reading in almost 3 years. Oil is falling. Inflation expectations are rising at the very same time. Those two don't usually move in opposite directions, and when they do, it normally means the crowd is watching the wrong number. Before we continue, if you want more videos that cut through the market hype and show you where the money is actually moving, subscribe, because that's exactly what this channel is built for. Alright, back to the real problem. I've seen this one before. 1999. Cheap oil, everyone calm, inflation's dead. You know how that decade ended. So if you're holding stocks and buying the dip because you think a rate cut is coming, give me the next few minutes before you add another $1. I'll show you the number the market's ignoring, why the bond market has already stopped believing the cheap gas story, and what I'm doing with my own money before the next inflation report lands. If you're new here, my name is Martin. I'm not a fund manager. I don't run money for anyone but myself. I was 33 the year oil hit $10 a barrel. I heard the same sentence you're hearing now, inflation's over, and I believed it. It cost me most of what I'd saved by the time that decade finished with me. Not because I was reckless, because nobody had ever taught me which number to watch. So that's what I do here. I read the numbers the headline skips. Right, so let's start with why falling oil fools people. Headline CPI, the number on the news, gets thrown around by gasoline and energy. Core CPI strips food and energy out, and that is the number the Fed actually watches. Think of it like your grocery bill. Petrol going down for a month is nice, but if your rent, your doctor, and your insurance keep climbing, your real cost of living is still going up. Remember that, because it's the whole game. And we've seen this exact illusion before. Let me take you back to 1999. Back then, Brent crashed to about $10 a barrel, an absolute historic low. Everyone assumed cheap energy meant inflation was finished, and the good times would roll forever. Then oil more than tripled within a year, and the old link between oil and stocks just broke after September that year. Markets partied right into the blow-off top. Sound familiar? And TradFi guys are drawing this exact parallel today, as the top 10 companies in the S&P are more overvalued now than in the late 90s. The 𝗪𝗪𝗡 ratio is sitting around 40, a level richer than before the 1929 crash. So that's the trap. Now here's the number they're ignoring. The New York Fed's one-year inflation expectations just spiked to 3.7%, the highest since September 2023. And here's the kicker. In that same survey, consumers said they expect gasoline prices to grow just 1.5%. So people are watching gas get cheaper and still bracing for higher inflation. Why? I'll tell you why. Things like medical care services and shelter are running hot. Health insurance premiums, which are a separate consumer cost, are jumping 21% in a year after the ACA subsidies expired. Some folks saw their marketplace premium go from $113 to $178 a month. That's a 58% increase. Allegedly nothing to worry about. And the bond market isn't buying the fairy tale either. The 10-year Treasury is sitting near 4.57%. The 30-year is above 5%. If disinflation were real, those yields would be falling off a cliff. They're not, because bond traders can read a survey. And here's where it gets worse. The new Fed chair, Kevin Warsh, has gone full hawk. He stripped out the easing bias, killed the forward guidance, and on July 1st said inflation is still too high.
Prices are too high, and I don't think I'm the only one on this stage that's recommitted to deliver price stability.
Quite a few officials on the dot plot are now penciling in a hike this year. 6 months ago, these guys were promising cuts. So think about what's actually happening. Retail is piling into overvalued AI names, betting on a loose Fed, right as the Fed's own survey and its own chairman scream the opposite. The institutions know this. They're already rotating out of AI software into value, financials, healthcare, and hard cash-generative stuff. Korea's 𝗏𝗏𝗡𝗏 already fell into a bear market on a chip sell-off despite record earnings. That's the smart money, raising cash while retail becomes the exit liquidity. Now look, let me be straight with you, because I'd be doing you a disservice otherwise. There's a chance I could be wrong here. A stronger dollar can actually pump nominal stock prices first, So this trap can take longer to spring than you think. The June jobs report came in at just 57,000, way below expectations, and weak jobs could eventually force the Fed's hand back toward cutting. The Cleveland Fed nowcast even sees June CPI easing slightly to around 3.9%. So this isn't a guarantee, and I'm not telling you to sell everything and hide in a bunker. But here's what I'm actually doing. I'm not chasing high beta tech into a CPI print with a hawkish Fed and sticky core inflation. I'm cashed up, patient, holding a bit of gold even after its pullback. I'm not buying a sector because a headline told me to. I'm asking one question of everything I hold. If costs keep climbing for another year, can this business hand that bill to somebody else? That's what sticky inflation actually tests. Not growth, not the story. Just who eats the increase. A business with pricing power passes it on. A business without it absorbs the cost, and you watch that disappear from the margin line. That question never leads me anywhere exciting. It leads me to insurers who reprice their premiums every single year, to banks that earn more when rates stay high, not less, to businesses already generating cash today, so they're not refinancing debt at 5% just to stay alive. None of that doubles in a quarter, but all of it gets paid because the cost of living is rising instead of getting punished by it. That premium increase we talked about earlier, the one that took someone from $113 a month to $178, somebody booked that as revenue. That's not a conspiracy, it's just the other side of the same trade. I'd rather be early and bored than fully invested and blindsided on July 14th. Because when everyone believes cheap gas kills inflation, that's exactly when the core numbers bite back. If you enjoyed this video, hit the like button, subscribe, and I'll see you in the next one.